Hey guys, how are you? I've got a big one for you, a really big one. The recession and crash indicators. The reset is already on. It's rolling quietly like a glacier under your feet. It goes quietly and quietly until suddenly it goes fast. That's right. And it's busy happening right here, right now. And I'm going to run you through all the key reset indicators you should have on your charts. Okay, let's just start kind of at a beginning. Dow Jones index. I'm not going to do the full index run through. I do a lot of those. I'm just going to do one flyby one of the indexes for you because it's important. I think this is going to be one of the last shoes to drop. In short, in other words, this thing is going to keep getting pumped up even when it's clear as day that the entire economy is sick as a dog. In fact, we're already there now, and it's going to continue. The perversion will continue for a while longer. Just have a look at the Dow Jones. Look, there's a slight possibility that we've had a triple top in. So I'll do a little scribble for you. If we take the pen here, we can see that we're like a pill, a jagged little pill in our throat. 26,500 hurts real bad. We can't swallow that one down. It got sold off quite aggressively there, got sold off super aggressively there, and it faced a sell-off again at that level. However, we have had periods similar to that, which then ended up going onwards and upwards. In fact, if I take you out of this draw zone and I just bring a little bit more of that history on, let's see if we can squeeze it on. Many would have been fooled into the head and shoulder potential of that and a neckline there and expected a reversal. Instead, you traded right up. This is why we trade continuation before head and shoulders, and generally indices grind their way up. But when they fall big. Let's do something else. I'm going to show you. Let's set the scale. I'm going to use the mouse for that. Set the scale so that you can see it in percentage terms. It is already logarithmic. Excellent. Now that'll give you an idea the degree of volatility we've experienced so far recently, and you'll be able to see if I just have the more recent write-up from the dot-com boom, you'll be able to see something interesting here. That was your dot-com fizzle. There was your 2000 and there was your sell-off. It was substantial, but in terms of volatility, we've probably fallen harder and faster during this period. I would say the only time that you've had a more aggressive fall, climb and fall, is in this larger broadening pattern over here with the highs of mid-2007 smashing down with the Lehman lows of 2009. There you had huge percentage move. Essentially you were in and around the 14,000 and you fell sub 7 into the mid 6s, over a 50%, and it was brutal. It was in 18 months it was done. So mega volatility, mega phoning, and we traded right out of that. Sideways megaphone, you generally trade right up. It wasn't upwards pointing. There you had the fake head and shoulders. Guess what? You traded right up. Generally within indices, the answer is right up. Triple top, we could trade higher. We could trade higher before we fall harder, but when we fall, it will be ugly. So the final shoe to drop will be the indices. They will keep the stock market going and flying for the longest as possible. So let's dispense with indices for a while because I've done a lot of work on indices and we'll do specifically only on indices again at another time in the future. Let's talk about those reset indicators. So first of all, a little bit of dollar milkshake theory. Will all the dollars have to come hoovering home and pushing the dollar up as emerging markets ever on debt in USD that have borrowed, that currency that's borrowed into existence, so there's always more needed in payments than there are around? Could you have that escalation climb as all the nation states seek dollars to pay back their dollar denominated debts? Think emerging markets, think all of these. Well, at the moment, let's just give you the laydown on the broader history. We've gone macro here. By the way, Real Vision did a real good series of tweets. That was Raul. You should follow Real Vision YouTube if you want to be stimulated and be reminded of macro. Like me, they like looking at the big time frame, and they have a number of people that are quite technically orientated. So go have a look there. But anyway, interesting series of macro tweets that he was doing about the euro dollar. I'm going to steer clear of that topic during this video, but we'll comment on it more specifically in other times. So here you've had the dollar at a supremacy, then you had the soft dollar period right the way down. The pound was strong through this period. In fact, at its apex, the pound went to 211 just before the subprime crash. That was round about there, the GBP USD. And since then, the pound has been terrible, heavily weighted in the financial world. What did you get? First major structure in a new trend, big breakout, falling wedge, again breakout, rising wedge, little drop down, and then snap back rally. And we are approaching key level of significance, 100 over here, and it was kind of like a little bit of resistance, and then a poke through, but we didn't hold for a while. Overall view is dollar is going to be one of the stronger currencies, but not the strongest. Wait and hear. I'll be telling you exactly which one of the fiat. So this, in this YouTube, I'm going to cover something for crypto guys. I'm going to cover something for the FX macro trade for guys that are only interested in FX, don't want to know about cryptos. I'm going to cover people that are interested across the board. I'm going to cover things that are even tied to commodities and precious metals for the bulls or the gold bugs, etc. So you're going to have your pick of what you want to choose. Some of them you might even have to synthetically create. Some of them will be direct trades on major pairs that are easy to put on simply. So let's close that. So dollar index, suspicion of further, might have a little bit of a rounding going on here. Took the pen away a little bit too soon. Might have a little bit of a rounding and an easing. We've snapped back, might churn, not too much dancing around by then, even a little drift off, set up continuation, and boom bosh, leave that 100 level behind to the upside. Okay, so this triggered an all-time period low with a first setup in a new trend, and the bias remains bull. The bias remains bull, but it's not a one-track bull like that was almost a one-track bear. It takes its time. Winds up, goes, continuation pattern, goes again, rests, comes off for now, until the great reset goes from the slow glacier into the oh wow, it's now headlines and mainstream news, and even Joe Schmo, who has no financial interest, is talking about it, the Lehman's moments of these times. So let's have a look at what's almost the inversion of this chart. So let me first, before I go, let's do it with a mouse actually, invert that chart. Invert the chart. Let me tell you something that's really powerful about doing this. It kills bull bias. It kills bull bias. So what have we got here? Note the colors won't have changed. So the greens are now the capitulation and the reds are now up moves. But what do you make of that chart? Let's take it up to the monthly and do that. You think it's going up, or do you think it's going down? For me, it's in a falling wedge. It's had a little pop out and it's got more downside for it. In other words, my bias to bull on the correct way around is a feeling of bearishness on this side. That was a very brutal fall, which was in fact a spike. Okay, so let's have a look at the Euro USD, how it looks relatively. Now that dollar index is in essence this got a large component of the euro, so it's quite binary, and then you add the franc and the pound, you're getting quite a lot of EU based currency in there in the mix. Then when I say the franc, the Swiss franc. Okay, so let's have a look at the euro, and let's just correct this for the right way around, because it's also got inverted scale. That should look a little bit like that dollar index was looking just before. So here you've had big moments of strength over here, convexing out, capitulation. You have made a marginally higher high, got very volatile, capitulation, small bounce, Falling wedge does mean you can get a pop-up, but it can also mean you fall out the bottom. Essentially, the wedge is a squeeze in volatility, and it means an impulsive move is coming. It doesn't mean it always breaks up like that. So you can get a spill out the bottom as well, or you can get a dip out the bottom before you get a snapback rally. So that's going to have to be seen. So many problems in the Eurozone. There's so many problems everywhere, actually, including the US. But let's talk about the Eurozone in one of its banks. Wow, Deutsche Bank. You know, we don't even talk in this space anymore. We were early onto this one. Now everybody's claiming it. It's like everybody's favorite beating box. This is just decimation from there to there. You're talking about a bank that was virtually €100 stock. Now that low was 12.5. We called this structure, said it's going to sell off. It sold off. I mean, across the time frames. That was its setup, by the way, for when it went up. Very bumpy, supported there, went into the 2008 crisis, highly leveraged, buying all the stuff, was the dumb money buying all the subprime in the room. Take a look at these on a shorter time frame. Let's go daily, if you will. We called this little setup for our trading community all the way down, just shorts, and more shorts. And this one performed on that YouTube. I said Deutsche Bank, whoop, let's get the pen back out. I said Deutsche Bank's going to trade sub €6. That was when it was around 7.9 and 8. There's your little squeeze. There she comes, €6. You traded the €5. 5.9 at that point on the purple line, 5.89 as you can see on that target. What's it doing? Let's drop the time frame again, clear again. What's it doing now? Let's close the drawer before we change the time, Francis. There you go. Whoops, another little squeeze. Wants to eke out a little bit more for you. That could take you to mid-5s. After just putting its toe through the 6 level, you're now looking at mid-5s, bleeding out. Ever smaller patterns, so it's probably going to get a push up at some point. It's too important to be allowed fail. Too big to fail, but it's great fun for shorting because there's no real value to had, and they're going to buy it if they're forced to at the absolute last moment. So it's a dire. By the way, it's not only German banks. Commerzbank, they were trying to merge it with Deutsche Bank in the sort of pre-collapse toxic bank marriage of the two ugliest girls in the village. Now you've also got Barclays that's worth looking at of the UK. Let's have it on the monthly as well. Similar type structure. It's ugly. This has never recovered. Other industries have been repumped from the giddy heights way back up top there. You had 720 pence and you traded at the bottoms here 40, literally avoided by the skin on its teeth of being bailed out by government, and was getting all sorts of dodgy Saudi money to come in, Abu Dhabi, etc., on crazy deals just to maintain its private and its autonomy from government control. So that it wasn't like Lloyd's, wasn't like Royal Bank of Scotland, wasn't like NatWest and all the brands rolled up in those two, which included BNP Paribas, etc. The whole basket of absolutely wrecked banks. But they're minor snapback, and then this structure, lots of selling across the top. Go suspect derivatives, very tight on the floor, leaning on the floor here. This is looking for the trap door. It is sick as a dog, a yellow canary in fact, and I can say that I am certainly short this equity. If you have a look at it, how's it been doing recently? Down she goes. Lots of nasty little setups. See this little fellow here. Technically we love these kind of things. Squeezes, volatility squeezes that lead to breakdowns. Down, and then a new level and down. So they slowly work and probe. You can go and milk this cow every now and then when there's a great setup. So those are the banks of Europe. the UK and a quick fly past Deutsche Bank, sick as canaries. Let's get onto currency. The currency traders are going to want to hear from me. What are the interesting things? So I've said dollar is going to, in the fear moments, will get a bid. People will still Pavlovian response run to the dollar. But there's a big difference between the Japanese yen and the dollar. And unlike Kyle Bass, I'm actually a fan for strength on the dollar, the yen, my apologies. So why do I say that? Why do I say that? Well, one of the reasons why I say that is, in fact, all their debt is in fact self-contained. They are the biggest saver nation of them all. They absolutely cover their own government. Yes, they've got crazy ass debt levels, but they cover their own government's debt with their own saving. Unlike America, that requires the rest of the world to save on its debt creation, Japan is a self-contained Ponzi scheme, unlike one that relies on other support. I need to get my, where is that chart? One which I've scribbled on. It seems I've lost it. Okay, so I'll do the draw here. So what have we got with this whole structure? Well, first of all, let's get the most recent period. These were the lows. Japan was getting just too strong, and just prior to a changing government, there was a rather unforeseen, which I actually traded, little inverted HVF that's tied in with a major collapse in the yen that was correlated to supposedly a natural event. That's right, the Fukushima earthquake. So that was quite shocking, and the yen actually strengthened on that, which should surprise you. There was a snapback rally, and then it dipped even lower still. The government of the day was thrown out. Abe, out of the blue, won an election and came with a 3 arrows policy, which is essentially to destroy currency, and went into a proliferation splurge. So out of that came breakout, rounded bottom, continuation patterns, rounded bottom, until such time, and this got the likes of Kyle Bass saying it's going to go 300, etc., potentially, and I disagreed with this. Until such time as they did it, I felt they were under duress from the other nations because the yen was too strong and had been for too long a while, and they were exceedingly comfortable with that. Look at that chart, downside, downside, downside. Go look at it against the GBP. At one point, the pound in the 80s, 680 yen to what it is today. It is a great surprise to many how strong actually across multiple decades the yen has truly been. So what did we then have over here? Well, let's have a look at it. This is called the fear currency. Whenever there's fear, and many people blame this to the carry trade, say, oh, it's a carry trade unwind. I think that's a simplified explanation. I think that's a made for media explanation. The carry trade was very much about interest rates, differentials, and people borrowing in yen to invest in other currencies. So what did we get? Left head and a right shoulder, your first mini. That was a major turn, brought you back to those levels. You got a snapback rally of some pace. We call that a classic first inverted HVF in a new trend, and we're expecting, after a small rally, given the dollar strength, note, given the recent dollar strength, what was happening in the yen. The fear that saw money going into the dollar saw more money go into the yen relatively for the exchange rate mechanism. Even if there was more money going to the dollar at a percentage level, the yen was getting more support and was beating the dollar out. Of course, when we had the spike of fear coming in here, you can see how quickly there was an absence of bid for the dollar against the yen. This is one currency for which you can get nasty spills. We are awaiting a substantial spill. Let's get my jaw up that's on my MT4. This has got our HVF draw tool on it. Let's pull this in here. Here you go, it'll be better for it. This will show you. We're looking for the 88.93 to be run on that. At the moment we're in the funnel. Sell any rallies up to 112.396. If you can see the point over there, sell rallies up to that level. That's where our stop placement is going to be. We're looking for not just sub 100, we're looking sub 90, and we're looking, and this will be a first in a new trend, and could see you revisit previous lows in the 70s with overperformance. You heard me right. This reset is going to be the crash of the mother of all crashes, and the yen is going to get the bid over the dollar. Even though I consider them both to be strong, the dominant one will be the yen between those two. That's right. So let's talk about it. Let's talk about it a bit further. Now I've made the case about that. So if you're an FX trader, your long pair should be the JPY. You want to also look at emergings to be your weak pair. Mexican peso, South African rand, Turkish lira, Brazilian real, anything with dollar denominated debt, because there should be some appreciation also in the dollar. That's going to lead to debt collapses for those currencies. That's already happening on the Pakistani rupee and some of the more peripheral emergings, but you won't easily be able to trade that. Okay, so let's have a look. The Great Reset, even the normal currencies that you can trade fairly easily on a broker that are somewhat exotic, they're still available and have liquidity, you'll be able to trade. So let's talk about Norwegian krona, Japanese yen. Okay, so now why is he doing this? Why is he bringing the krona in? Oil. It's an oil currency that is otherwise a stable democracy. Yeah, so you get it. So when we have a serious downturn, the demand for oil goes down. The demand for oil goes down. It's the Rockefeller tax. It's the global tax on everybody. And when nobody's got any money and nobody is spending, oil has to go down because no one's buying anything, no one's driving anywhere, nothing's being transported, the logistics industry is slowing down. Oil is in everything. So this currency will run into trouble if that is starting to happen already. The fear value, in other words, the safety of the yen, will gain. So let's have a look at the Norwegian krona. The krona. Bring him on, bring him on. Let's first test the hypothesis as well. Let me give you some real history here. So what do you see? First of all, overall you're seeing the power of the yen. You're seeing the Norwegian krona actually lose ground. And remember, this is a pretty solid country, socialist indeed, yes, but sitting on a major wealth of natural resources. So you can see from whence it comes in terms of the yen. You aren't seeing those levels anymore. And what you've actually got is there's two sets of lines I've drawn here. The kind of trend that I'm saying across the tops and the bottoms, you can see that that's actually a loss of value for the yen. My apologies, the krona versus the yen, that's yen strength. So we are dropping, we're roughly above the midpoint here, that orange line that I've drawn there. Given that chimp. You did have a surge here. What did this go with? Well, unsurprisingly, it was the boom period prior to the 2008 crash, when oil was 130, 140 plus dollars, going for 150, and everyone was flush, and everyone was spending, buying cars, buying products, buying everything. You popped out your top of your range there. And what happened with 2008? You revisited the lower half. You didn't go as low as you were at the dot-com lows. Didn't go as low as you were at the dot-com lows. Note the stress points, and you can see the lows. Now, kind of, let's clear the face a bit, kind of in squeezing wedge here in the green again. Now, if you took, if you said, hey, yeah, there is a bit of a downward bias, but let's just say we treated this as a range trading pair where the krona is holding its own, I would tops and tails, as I've done the two blue lines, where whenever you're down here, you're in a collapse. You get where I'm taking you? And whenever you're above, you're in a boom. This is 2007 boom. This is the run-up of the 90s boom. You had a partial boom, but not quite high enough in the run-up to the dot-com. You certainly had it, everyone feeling flush prior to the 2008 crash. You've got your panic zones here. There you have it, 2000. There you have it, 2009, not once but twice. Then you had a major fear moment, 2016. Now I'm going to come back at you on 2016. As we entered 2016, we called on World Vision that in 2015 October there would be a nasty downturn and negative feel in 16. That was the realization of China's highly indebtedness. China was buying all the commodities in the post the 2009 bust. That's how Australia floated through not having a property bust. Why? Because of China, and they went from virtually no debt to super over indebted to the Shanghai Accord, as Jim Reichard has referred to it, when all the Group 20 were in a real panic and met in the early part of 2016, and then they came out with a solution and a plan and everything was put away. There was true fear here, and in some of the indicators the 2016 sell-off was even larger than the big great financial crisis. So there you go. You can see your stress points. Hold on, where are we now? That's where we are now. Let's just do that again for you guys. That's where we are right now. That's where we are right now. You have your 2016 moments. You have your bouncing along the bottom moments of the big 2009 great financial crisis, and you have your dot-com crash. And that's where you are. Reset time. Only this time, it's my view, we'll go even deeper. This is going to mean reduced demand for oil, more fear running into the yen. Yes, you FX traders, watch for short-term setups on the Norwegian kroner. You'll get decent liquidity. Okay, there's more to say on currencies, if I'm frank. There's a lot more currencies we could look at. I would certainly look at the emerging against the yen. So rand versus yen, lira versus yen. The thing is, you've got to get your timing right, because some of the carry trade costs of those, given the interest rate differentials, can be quite high. The lira, it's going to cost you to hold that trade open, but you will make P&L. So I'm not going to drill all the way through for the FX. I've told you which one's your strong one, the JPY. I've told you that oil-based currencies will run into trouble, and emerging with dollar debt will run into trouble. Go run the rack. You want to be long yen, short emergings. Okay, reset indicator category. Let's change category, shall we? SHYG. What the hell is that, you might ask? So let's take it out of monthly. In fact, let's stick it in W, which being the weekly, and show you what you got here. Now look at those convex structures. Wow. This is the shares of a 0 to 5 year high yield. What is high yield? Junk, bad rated, high risk corporate bonds, companies that are battling along. Now there's 15% of companies that are borrowing from banks to pay their dividends. Okay, so those kind of guys, if this is the good times, God forbid the bad times, those are the kind of guys whose debt's going to become a real problem. So let's have a little look at this. Now what you might note, I refer to it as convexity. You'll learn a whole bunch more on an HVF method programming course, trading course, but that is this roundedness that tends to make a doming out and then collapse. Little continuation there for the downside, nasty spill, snap back and spill. Again, all the way down here. That is not good structure. This kind of stuff is indicating stress. It's had a snapback rally just as we had the end of the year. The end of the year equity sell. We said in October. We said in July that October was 33 months from the first rate rise, and that we would have typically the fear and the beginning of inversions and the beginning of share sell-offs, because you're now almost 3 years, 33 months from the first rate rise in a new rate rise cycle. And that was the Fed reversed quickly hereafter during this period. What happened? Stock market in October crashed. We said in July, October will be the 33rd month, and sure as hell, October was the peak for the equities. It was a bit lucky, and you got collapsed. What happened to your yields on your value of your corporate yield debt? It fell badly. And guess what? Genie back in the box, repump up, no cut rates. We'll go from being tighteners to not only being flat, the next rate move is a cut. And by the way, remember that inversion trick. Let's do that again for you. If you're thinking, oh, I'm not so sure, that's so bearish looking, tell me how you feel about this chart this way around. So same chart, and once again, use the inversion of scale. Now that to me has got beautiful rounded bottoms. Those same convex tops are rounded bottoms on the bull side. That's a powerful uptrend. Rounded bottom spike, rounded bottom spike. Hey, next one coming here, setting up a beautiful macro structure for a mega spike to 0. That scale is inverted, and that means down. Okay, so that's your high yield debt. Sorry, I like to entertain myself during this process, and that is corporate debt. Let's have a look at HYG. Yes, similar category. iBox US high yield corporate bonds ETF. Again, that convex structure. I've drawn the pattern and I've drawn the trade for you. We would trade this short. And we trade it all the way to our target, and that target is a long way away, and we would expect overperformance because this is one mega macro pattern. Let's get this straight. Keep it on the screen, Francis. Don't lose everybody in the process. Come on, mate. Sometimes the touchy screen works, sometimes it's a little bit iffy. So you'll see that coming down from 87 to 48.55. That is pretty nasty. You can see the sell-off that occurred in the October high period down here, coming into the back end of last year, and then down, and then the reflation effort. Once again, have a look at this chart the other way around. It is a beauty. I would trade that long, and it certainly means that I'm trading this short. So you're getting ideas here, guys. You're getting ideas. This is the kind of things we share and discuss in our community, and you're getting real reset prep here. The 3 great circles: market sniper, the method, the charting, understanding how to analyze. The big time frame charts are your macro. People that said charts are only for timing aren't looking at big enough time frame charts. It's for the entire move. It's the best setups in town. It's all there. It's laid on for you. What are you kidding me? Are you looking at 5-minute charts? Good luck. Okay, so here we go. We have the crypto sniper, the third, which I'm coming to, and why we think one of the big winners out of this great reset will be cryptos, but don't get all beliefy about it all. The NSA's probably got a nice big hand in it. Look at that lovely rounded bottom. Look at that rally. Another round bottom. These are cups. You'll get the technical analysis, traditional guys. Cups and saucers, cups and saucers. That's useless to you, mate. This is a fabulous volatility squeeze. This was an epic moment of volatility that will be surpassed potentially in the Great Reset. This epic move was your 2008 crash. That was your sag back to normality. Remember, we're upside down now on the scaling. It's getting lower on the numbers. That was another spike of fear. Guess what? 2016, that story I was giving you about China, that gave you your second impulse, first impulse, second impulse, and then you got the back end of our 33 months since the first rate increase of the Fed that gave you that little scare, and then the renormalization. That is your 3-wave structure that we look for in an HVF. That is your target. That is a massive loss of value, and that can be leveraged. That is high yield corporate debt. Guess what? Those guys are going to hurt. They're going to hurt, and the banks are going to be hurting with them, and they ain't going to be wanting to lend, and they ain't going to be wanting to roll that debt. No siree. It's going to get nasty. It's going to get ugly, and there's going to be a lot of crying, and there shouldn't be crying allowed in baseball. Okay, so what do you have here? Yield inversions. Oh my God. It's not when the yield inverts, it's the fact that it's inverted. It often happens while you're still inverted, coming on the way back out, or after you've fully come out. So what have we got here? Let's have a little look. US 10-year. Let's do it on the monthly. We can drop to the weekly later. When last? I've got since 2002. It's a pity that we're just dropping the 2000 data, but unfortunately, a lot of these data providers don't give me sufficient data. For macro charting, you want the guys that give you data, man. You want all those big crashes. You want to see how wild it can get. You need that reminder. You need 87 in your charts. You know, you need 90s in your charts. You need the 2000 crash in your charts. But you can see what happened here with '07. This is prior to the great financial crisis. You bounced at almost, this is the difference between the 10-year and the 1 month treasury. So we're taking what gets paid on debt on a 1 month and what gets paid in a 10-year. You're taking the 1 month away from the 10-year. And what's happened? This was a difference. Big fall away, '04, '05. During this period, by the way, gold and silver were climbing here up. They were dropping their pants with the lending criteria, and at the same time gold and silver were saying, yeah, I know how this one ends up. Then you got your yield inversion starting there. '06, late '06, prior to '07. Then round about here is '07. You were still in the inverted state, running up to here, and then bang. Then you ended up in the Lehman's moment. Woo, nasty, 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 nasty. Guess where you are right now? Yes, sir, that is where you are. Roughly here. You are there. You are there. That moment there. You are now at that moment there right now. The reset sniper. We've been telling you about it. It's coming. It's big. It's going to be brutal. You can come out of this far wealthier, or you could be battered. It matters how you set yourself up for this period. The signs are there. It's busy happening under your feet. People don't even realize it. The tectonic plates are shifting. Here endeth the epistle. Let's do another yield curve for you. That's the US 10-year minus a 3-month. So there's many ways that yield curves could measure. I like this one because it's actually got a bit more history. History. Give me history. Yeah. Those that do not know their history are destined to repeat it. That is truth indeed. So let's get that line in. Where do you drop negative? That's your 0 line, friends. Whoop. Oh dear, more bad news for you guys. Or maybe it's good news. It depends how you set yourself out. I think it's good news. I want this fantasy economic realm to end, and I want it to be a major haymaker of wealth for those that are smart and understand the game. You could be that person. You need to be around smart people, and I'm not saying that's me, around lots of people that have an idea and are fascinated with studying this. I certainly put myself in that category, not the smart category, but let's have a look. So there you go. That was a key moment. When was that? Ooh, late 1999. What was about to go wrong then? Bang, 2000. Look at that inversion. Here you go. First touch. Around about '06, proper breakthrough, late part of '06 to the beginning of '07. Bang, you all know what happened there. Here you are today. Let me tell you, it is the safest, surest aspect of stating that we are in deep, deep, deep trouble. Not little bit of trouble, deep, deep trouble, guys. And it's coming. It's coming. It's here. It's here. It's going to dip a little lower. It's going to start reversing back out. And then round about then, you're going to start reading about it in the headlines. That is a fact. Yield curve inversion. One of the most reliable indicators there is. One of the most reliable indicators there is. One more time. For a major great recession, and there won't be any small ones in this environment, the yield curve inversion is almost 100%. Almost 100% for guaranteeing you a recession. And as I say, they don't come small with the amount of garbage we've created. Okay, so the reset's here. You can sit in denial, or you can ask yourself, what the hell am I goddamn doing about it, and how am I positioned? How's my finances set out? Okay, let's have a look. Let's change tempo. Oh, so heavy, Francis. Oh. Okay, gold. Finally, the gold burst there. I've been hammering the gold bugs. I don't believe in belief systems. I don't believe in much, actually. I like to assess and have a probability-based scenario. And all throughout this period, we've asserted it's still too soon. Sorry, gold bugs, you're too early. Your reasoning is right. Your timing is wrong. Your reasoning is right, but your timing is wrong. No low there. Then you went here. Breakout, lots of excitement, then it came nearly all the way back. You now have a key level, 1350, key level, 1350, that dark blue line, key critical level. Let's have a look at the structure a little bit more. Remember, this is against the dollar, gold against the dollar. So we're talking gold and the dollar. This is very bullish now, finally encouraging signs for the dollar, but it's going to be in fits and starts. It's going to tease and tease. It's going to tease and tease, but I will prove to you that it is coming now finally for the dollar. So this third impulse, what do I like about it? Falling wedge into the low. That is good because it set up the squeeze. That showed tactical and technical buying on the dips. Central banks are accumulating at a rapid rate. This 1350 has been a jagged pill that you can't swallow at the moment. Come on, right nicely. And many times tapped out. You get above this level, what was previously exceedingly aggressive resistance will now become support. It's been resistance since 16. Oh, by the way, 2016, that great China debt story. That's what happened for precious metals until they put the genie back in the bottle and allowed the dollar to slip a little bit and the Chinese yuan pegged to it to go down with it as well, and kind of try their best at a coordinated across all the key central banks soft landing for the suddenly indebted China that did all the growth during the no heat years post the 2008 and 9 in the Western economies. Okay, so long ugly second impulse, quite a steady fall, but you can see the buying has come up underneath this, then a move up, and now it's come up quite dramatically, and then that has been quite an impulsive spike, and we're holding this zone. Apart from here, we haven't stayed up there very long, very many times since 2016, and we're coming up at real momentum. So let's clear that. So gold is looking like it's knocking on the door. It's looking like it's knocking on the door, but that is a shooting star, guys. Let's just catch up with that. Again, if you just go leverage right now and you don't get your timing right, you could have a pullback all the way to the orange line here and below before it comes back up again. It is winding up to take the level, but it is facing selling, a wall of selling. They don't like to see the big canary in the mine chirping. Who does he mean by they? That's a story for another day. But they don't like to see it. It is bad economy indicator, and they don't want that truth getting out. So they're going to keep stamping on it until they can't stamp on it no more. Keep ordering, taking your physical out of the system, not electronic, not in ETF, physical delivery. Take it, own it, hold it, feel it in your hand. Then put it somewhere safe. Okay, so let's have a look. That was all about the dollar. Now the dollar is going to be one of the stronger currencies out there. So how's it looking against the euro? Dollar, euro. Let's have a little smack and smell the roses here in Euroland. Nice little upside HVF target 1686, currently trading 1196. Wouldn't you like a little bit of that? How about another $600 or $500 at least on top of your euro? That could see you pick up better part of 40% in your euro valuation setup structure. So we've got structure setting up longs on the gold versus the euro. What about the gold versus the pound? Same again. Could see it hit £1,500. £1,500, everybody. That would be amazing. Only just crossed the level of 1,000 not so long ago in the last month and a bit. 1,500 from 1,067, looking good. What about that yen? So I said the yen's going to be one of the strongest currencies, stronger than the dollar. One of the few currencies that is going to be stronger than the dollar. How's it set up technically? That's how it's set up technically, guys. That is called a classic continuation pattern. While it hasn't broken as far yet as the others, uptrend, volatility squeeze, continuation, and break, and Bob's your uncle. You're starting at 145, before you know it, you're through 180. And that's against the strongest fiat out there that stopped kind of proliferating for a bit and has next to negative rates. Guess what? Gold doesn't charge you interest. It may not pay you interest, but it sure as hell doesn't charge you. Some of you will say, yeah, but you got to pay to store it. No, you don't. Just put it under your floorboards and don't tell nobody about it. Yeah, know what I mean? Okay, and no worries there. How about the emergings? So I'm down on emergings. They're dollar leveraged. There's going to be a shortage of dollars. Dollar's going to do one of the best currencies apart from the yen. What about those emergings? Well, this is how gold looks against the Turkish lira. Smart Turks own gold, even more than dollars. Smart Turks own gold. This is your monthly chart. How about that? Wouldn't mind some of those apples. You could have had it in 2006 for roughly, what's it, 500 lira? 500 lira down here. Anyone? Yeah, and how are we doing now? Oops, a little bit of almost 8,000 and tapped out at 1.8750. 500 to 8,750, half a thousand to 8.7 thousand. It ain't good. It ain't good in the emerging market. One of the worst. One of the worst. But the lira does pay you a little bit of interest. They have to. They've had to hike it up a lot recently since the melt up there. But so let's quit the likes of the lira. Let's talk about the Aussie. A fairly sober currency, commodity currency. Actually creates some gold. We'll have a little bit of gold hunting value in it. How's it looking? Very similar to all the others. Continuation. Key level that was highly significant around the 1850, there, and there. What have you got? The buying's coming up underneath those lows, nibbling the lows, and you're popping out the top. By the way, Australia, like certain other countries, one of the earliest ones along with China to do 4 nines purity of gold. Yeah, you can buy your swans 0.9999, 99.99% purity. That means a lot of gold in there with very little other. And China's doing that now, and a few others. So very high quality coins available, and usually priced one of the most aggressive, the least implied coinage value. But bars are best. Bars are best, but you know, it all depends what level you're at. So let's close that. So gold is a buy. Let's talk about this gold silver ratio. Come on, guys, we've got to talk about the gold silver ratio. So here's where we at in la land. And precious metals are most undervalued when the gold silver ratio is mega high. It means that silver is particularly undervalued, but generally precious metals as a whole are undervalued. Okay, so what have we got here? What have we got? Well, you know, in the old history, you used to have around 15 and etc. 15 to 16 silver ounces bought you 1 gold ounce. The modern era, and we haven't got much chart history here. I'm really peed about that, but this is probably the longest I can get with both of these on TradingView. We've only got subsequent to 2000. So let's just call it the modern era since the subprime collapse, just prior and up to today. In the modern era, your average is probably around 61. Your highest 0.5% extremists at 90, you're only just stuck through very first time today. You couldn't even make it at the excessive undervaluation of gold and silver at the subprime lows. You couldn't even make it. 90. You were below 90 here, and that was the biggest buy signal of gold, because they came with their cure, aka cut the interest rates, quantitative easing, and guess what? This time there's a whole bunch less interest rates to be cut. So just imagine that QE and the proliferation of fiat to reinflate balance sheets and rebuild the banks, shore the banks' balance sheets up, and to reshore all the big corporates that are now deemed too big to fail, only no longer just banks. Now any business that has a mega corporate and has a CEO who attends the Bilderberg meeting. Okay, that's how it's going to go. Off you go. That was your bull market, Q1 2011. You had $50 silver, just under 49 and a bit, and you had 1927 gold. That 50 went roughly 38 times in there, and you would have had, is it 38? Yeah, it's around there. So you might have had a little bit better. Maybe the gold topped out, they didn't perfectly coincide when this was 49, because you got a low level round about there. That's around the 30, 32. So it's in this range, and that was your extremist point of the bull market that then had the snapback There she goes. What are we in at the super macro level? Super macro level. What pattern did he draw? There's the upside break that saw the devaluation in precious metals. There's the grind line and the selling there that saw the capitulation. What is this huge technical structure that is drawn? Let's do it again and just concentrate on that. In the red lines, a mega rising wedge, a mega rising wedge. You know what? You can actually pop out the top of a wedge before you have a sell-off down. But boy, that'll just give you even better opportunity if we run 100 and it requires 100 ounces of silver to get just a single ounce of gold. Then you just stockpile the silver and you wait, and you have a little bit of gold too, because it's good to have them both. It's more portable. So the midpoint is roughly 61, 32, call it 30. I would say we got to 30 here. I should have done that at 30. 30 and 90 gives you 60 midpoint in the modern era. Remember, this has been the modern era of credit expansion. If we go back to the 15s, and remember, that which overshoots to 100 could undershoot to 2 or 3, and I'm not saying that it will, but that which overstretches to the upside can undershoot. What if we went back to 15? What if we went even below 15? What could a silver ounce be worth? How much do you have? This is mega. Remember, this is just a short period of history. We've got 7 to 19, 12 years. It's a little snap of the finger. It's a blink of the eye in terms of history for 3,000 plus years, even more. Money that has always been accepted money, even when the power's off Bitcoin, guys, even when mining rigs can't run, even when mobile networks and the internet's down, is money. Okay, keep that in mind. Okay, so we're really knocking the lights out on the precious metals here. Let's go to platinum. Most undervalued current precious metal. Why? Automotive vehicles. Mainly diesels use the most amount of platinum. Car sales are going down. I think car sales are a write-off. I think it's going to go down lower. I think platinum will get cheaper before it gets stronger, and you should continue to buy it all the way through the dip. Because if you're holding long enough and you're patient enough and you've got enough cash for other things, don't overbuy and then have to be forced sellers lower down. If you can hold long enough, this is going to come back. It has all the properties. This is the king. Platinum is king of gold. Most of its history, it's king of gold. Platinum is king of gold. I have to show you this chart. Let's go to this chart and we'll come back to platinum. I have to show you this chart. Most of the time, this chart that you're looking at, platinum divided by gold, is how many ounces of gold you got for 1 ounce of platinum. That right there, that gray line, is the 1 number. Again, disappointing amount of history. This is something I've followed for many, many years, from my teens. Just about all of time, bearing very few short exceptions, platinum traded higher than gold by between 10, 15, occasionally 20%. It's far rarer, it's far more difficult to find. The only reason it is absolutely wrecked right now is that 40% of its use is catalytic converters for diesel cars. Diesels are being, not only cars are selling less, and that particular category of car is being phased out. So its industrial usage is all but disappearing until it is just a precious metal for jewelry and for bullion sales and a couple other minor industrial uses. Then you will have hit your bottom, and that's okay, because guess what, the electric car is coming and all of that. So this has lower to go, but let me say to you that when it moves, it's going to have catch up. You saw how it sold up top here. You saw how it sold up top here. It was really high at one point when the diesel demand was super, super high and everyone was buying diesels. So let's go back to the platinum chart again. Now you understand. That was a falling wedge that you just saw. So this is undervalued, and I suspect it could go sideways and get further undervalued and even challenge this point. By the way, precious metals peak, you can see 2,300. Gold didn't get that far. That is typical of platinum and started moving sooner and more wildly. But it never recovered from that smackdown in quite the same way, and it fell sooner and then down, 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 second level. But it is the long-term patient man's bullion of choice. It is cheaper relatively than even silver. Silver is next cheapest. Palladium is overpriced relative to the other precious metals, and gold is gaining ground. So Let's take another switch. So you can do many things with gold. Gold is money. So you can do a gold assessment to oil. Now here's a key indicator. I'm giving you a list of recession and crash indicators. Pause this video, write them down, save these charts, analyze them yourself, monitor the reset coming into town yourself with all these key indicators. This is a technical analyst's recession and crash indicators video, and I'm giving you every one I know right now. This is my intellectual property on economics, technically done, vomited up on the screen. Capture it, pause and watch. So what have I done? I've taken an ounce of gold and I'm dividing it by oil. Now the key thing is recessions occur. Gold goes up, oil goes down. The recessionary activity sees reduced economic activity, that sees oil going down. It's a Rockefeller tax. It's a tax on all activity when everyone is spending, and it's how the control structure that is all owned etc., by the oil cartels and the politics that involve oil, etc., across governments. They all skim all that extra froth for themselves when everyone is flush and that liquidity. And guess what? They need to cut it back brutally when no one is spending so that they can stimulate activity, and even still it's not enough. So they do the monetary policy, the QE and everything else. So often commodities move in lockstep. When you have major recessions, the gold goes up in anticipation of fiat proliferation and interest rate cuts, and the oil goes down. So when these are going in inverse directions, to the positive side for gold and the negative side for oil, this is your crash indicator. I've done similar as I did for NOK JPY. I've done a horizontal extremities line in blue between 30 and 14. And you can see the modern era since the 2008 paradigm, which was a shape-shifting moment. And then you can also see the green lines that show the kind of trend. What does the trend show? The trend shows gold going up in value against oil. In other words, people are creeping towards recognizing that this is a ruined economy and they need the hedge and the safety, the insurance policy that gold gives you. So in the run-up, in the lazy days, everything is hunky-dory of 06, 05, etc., gold was very low in price and oil was relatively strong. In fact, 1 ounce of gold could only buy you 6 barrels of oil. 1 ounce of gold only got you 6 barrels of oil. Can you believe that? 1 ounce of gold, 6 barrels of oil. Then you're at this low point over here, and I've done this for the trend version of this. I've done it like that with a midpoint, showing you that we're roughly at the midpoint right now. You get these nasty little spikes that often have a habit of occurring just as the QE gets announced. Guess what? No one's spending, no one's doing any economic activity, and they're killing currency. What happens? Major spike. So the spiking of this indicator is your recession indicator. People are dead in terms of spending, and the smart money is getting into gold in anticipation of fiat currency devaluation. Then you get snapped back, and then the semi-calm, low, low, low. Remember that 2016 event I said to you that was pretty darn ugly for China? Who was buying whole ton and big importer of oil? China. And where did that demand go? It disappeared. And what did people start doing? Especially the Chinese central bank, the Russian central bank, and all of these. You got a mega spike here. Actually, this outweighs what happened in 2008-09. This gives perspective to what a debt crisis that was, and how, as a commodity buyer of last resort, when China's wheels fell off, leading into 14, this is when the oil price fell. July 14, it broke out of an inverted HVF. Anyone who's ever followed me, at $104, we called it short with overperformance. The oil market, July 14, right there. And it fell, and it even surpassed our own expectation in overperformance, taking out the subprime low and trading in the 20s. During that period, gold was going up, oil was going down. That was your stress in the system. It was huge. What's happened since? We were all hunky-dory and calm along a low here on this increasing value of gold to oil general trend. But we were on the lows of that. That was running up to our 2018 October crash, another key economic event. What did you get? Oil down, Gold buying up. You've had a little bit of a pullback, and now we're going there. What do you think's happening next here? Higher up and a super spike to end all super spikes, or coming down? This will tell you your view on the global macroeconomics. If you think the global economy is going to be spending more, buying more cars, more economic activity is going to be spurned. By the way, the non-farm number was atrocious, 75,000 jobs created, real economic. The Fed wants to cut rates, the yield curve's inverted, all these other things I've shown you. The banks are still collapsing, etc., etc. The Japanese yen is getting ready for a fear spike, etc., etc. You should think carefully about choosing that option. I would suggest probabilities are super spike, gold versus oil, and the gold has already started running and the oil has been limp. By the way, price of oil not moves particularly much up following 2 oil tankers blowing up in the Straits of Hormuz. Even geopolitical events of suspicious nature aren't budging the oil price. You should know there is a problem out there. Houston, we have a problem. Let's change tack. Housing. How about the US housing market? One of the indicators of US housing, lumber. Yes, wow, we're throwing indicators at you. This video is for the committed here. You've got to watch this. You've got to watch, and you've got to be committed, because we're running the rack here. This is for people that really want to understand the game. So what do we have? Well, you have the pre-2008 era and you have the post-2008 era. That is the range for lumber, with the midpoint pre-2000, my apologies, pre the Greenspan, allowing the proliferation. This is way further back. So he said irrational exuberance around about 96 during the dot-com boom. He was in charge since 87, round about there. So it didn't take long for Mr. Low Interest Rates to actually create all forms of housing bubbles and to create a new paradigm for lumber. And why lumber is used in property in the US, most of the houses are wooden, etc., etc. That sounds weird to us, to the Americans. I know that must sound normal, absolutely logical, but for people all over the world, that's how it is. So you've got this new normal of lumber prices, which was more volatile and generally higher, but more volatile. Look at these swings for lumber. Guys go in and out of business like it's going out of fashion. Super spike there, reflation into the October highs. Boom. We'll look at the Case-Shiller property markets, and down she goes. Down she goes. Down she goes hard. Mega slack down. That's a proper shooting star. What do you see come back in the new normal era since the beginning of the 90s, which is, bearing in mind, it took Greenspan 3 years to get his feet under the table and do his print fest and low interest rate environments and largely benign neglect of economic management. And what did you have? Well, here's your 08 dip running into 09. This is your horrific period where houses were just being knocked down, no new ones were being built. This was 2007, and you hit your peak on lumber. This was your warning for property. You could have said it already in 05. Going into 06, it was already coming down. What happened in the 2000s? Pump, big prices in the dot-com, pump, irrational exuberance, chop, 2000, post the 2000, your absolute dip low. Reflation, subprime crisis, bigger crash. So the volatility has expanded. So actually we could divide this zone up. Clear it one more time, Francis. Show the guys what you're thinking. There's your kind of pre-Greenspan era. I'll get it out of my mouth eventually. He came in here. Then you have your super spike Greenspan era here, and then actually you have your 2007 2008 period here, where you now have this extremis low and this mega spike high, and you have this obscene volatility. That's how I'd segment that. There's your 2 stall boxes of price behavior for lumber. How it was in the less aggressive pre-Greenspan world before he got his hands around the throttle, how it became far more volatile and more expensive, and then super volatile and a speculative asset. Where do you think this goes? Back up there, or a little bit of a revisit for a new all-time low down here? Well, we have the Case-Shiller for you. Let's have a look at housing. Now I've got the housing here, and you should think that looks all hunky-dory. Well, what I'm going to do is I'm going to divide it by gold. I'm going to apply gold by troy ounces. So let's have a look at housing in terms of gold ounces. Let's go. Come on, guys. Let's have an enter there, and let's see if you can give me that chart. So that is the housing price at 20 city in the States. Data series. Add gold. Add gold. Come on. Let's try again. We'll get there in the end. No, it's not playing. Okay, so what I wanted to show you was gold. For some reason I've lost functionality here. Essentially this goes like this and dips, and then in gold ounces property is a whole bunch lower. Why? Because during this period gold was continuing to go up in value from its lows. So actually property is already in gold ounces cheaper than it was in 2008. So it's showing the strain. It's already showing the strain. In fiat terms, remember we've proliferated it, it's been reinflated up, and in some areas marginally higher than what before. But that is in destroyed dollar value. What about traders? We're talking about trading. What about us traders? Wow, can you believe us? You've watched for over an hour. I hope this is interesting for you. So here is Charles Schwab, good old Charlie, Chucky, and the gang. Now, the traders like a bit of leverage. They like to borrow. Margin lending was getting to all-time highs. Guess what? As they start blowing themselves up, as they start losing money, less commissions, less revenue, and less money made. What do we have here from Charles Schwab? Let's have the pen. So have a look. This is an economic indicator. The traders, how much money they're making, and are the retail stockbrokers making money? Left shoulder, head, right shoulder, neckline, target made. What are we doing here? We're drawing an inverted HVF. Let's close that. Let's take it into the daily. Yep, that's right. We're trading short on Charles Schwab right now. And in fact, we've got a better one for you. That's right, a better one. We're expecting more downside on a retail stockbroker. Remember they went bust. They went bust in .com as well. Let's take a look at Ameritrade. Let's do Ameritrade. Ameritrade has more outages than Schwabi and has also had a kind of topping experience. And what do we have now on Ameritrade? Looks like we could have the first inverted setup in a new trend. Down, look at that trend is down, down, down. We're on the daily. What's happening? If the stockbrokers are making less money, our indicators of overall success in the markets for retail stockbrokers is down. Downward trend, snapback, rally, reactional, nasty sell. Kind of a three top structure there, close to a head and shoulders, not quite. Second convex loop, retreat, retrace, snappy and short, squeezing, squeezing, squeezy, squeezy, Japanesey. Down you go to the downside, target at 39, currently trading 50.52, has been at 55. Big drop. Big drop and overperformance possible. First setup in a new trend. You'll learn all about that on a full program and what it means. So there you go. What about cars? I told you I don't like cars. Cars are going down, down, down. Start with America's favorite, Ford. Yep, Ford. We're whipping you through indices and indicators here, guys, at a rapid rate. I've got so much to cover and we've got to run you through it all. You want to know how to check if the economy is hunky-dory. Guess what? Last time Ford was a hit was way back prior to the 2000 bust. It never recovered from that descending triangle. It bottomed in 2009 a second time after that structure broke down. They snapped back, bought it. It was the only one officially that didn't take state money, although in the end it was forced to take in its funding area. That is a downtrend channel that is heading down. Down, guys, down. Trucks are out of fashion. People, these are big expenditures. Subprime motors, wow, the banks are going to run into trouble. The lending's going to dry up. No more 70 months, 7 years to pay off a car, and you're buying half of it on a shotgun deal. Are you freaking crazy? When that finance stops, how many people are going to be, oh, I just need to know if I can afford the payment, when they're selling $85,000 trucks? No, you don't. You need to know how much money you're borrowing. That's what you need to know. Way too much for a depreciating asset that is a massive gas guzzler, costs you a fortune, and is not the status symbol it used to be. Okay, downtrend. That's Ford. Let's move on to another car. company, Fiat Chrysler Automobiles. Now, I think this is the pig of pigs. Let's go daily. So big double top, another setup forming right now on Fiat Chrysler. That's your double top that we would have drawn on a retrospect there. There you go, double, toil and trouble. Down you go, make your target, snap back, rally, squeeze, little bit of a fall, snap back, squeezing, squeezy, more Japanesey, only not a Japanese car, an American one, dying part the way to its target of 12 from 16. Up top here was 24.5. You're looking at something that's 50% loss. Your Fiat and your Chrysler vehicles down potentially 50%. How'd you like them apples? Then there's my old friend Tesla. We called this one, we spoke about it, we said falling wedge, you're going to break out of a structure over here. You can see that video, so I'm not going to recap it too much. I said when we're at 266 over there that you would run 180 and you should trade 180. Where did the 180 come from? How did he get to 180? What's he talking about? Go check the whole video. We said it before it happened and we traded it. That was your 180. Key levels of significance. This is an interesting story. Like the Real Vision guys, I'm smelling rodents all over the place. There's a rat in my kitchen. What am I going to do? But guess what? I think it's control structure, and I think it may rally for a bit, may come back up to these levels and come back down. You might get the mother of Head and Shoulders, you might not. But there's certain people behind him that don't want him to fail. It's all behind the totalitarian state of monitoring, surveillance, and tracking. And here's the vanguard for that AI movement, while saying, oh, I don't know if I like this AI. Trying to keep himself on the right side of the masses. Cars, down with cars, short cars, subprime cars, get rid of. Let's talk crypto. Okay, I told you what my trade of the year was, the 2019 trade of the year. I think the Southeast Asian currencies are going to run into a lot of trouble. The Hong Kong dollar, the Korean won. I think the Korean won is going to run into a lot of trouble. So my trade of the decade was the year, who knows, time frame, is the Bitcoin against the Korean won. But I respect that most of you are not in Korea that can sell your local fiat and buy Bitcoin. But you can choose any Southeast Asian or emerging currency. That could mean rands, liras, Mexican pesos. That could mean Eastern European currencies against the Bitcoin. It can even be the dollar and the yen against Bitcoin. Bitcoin will beat them all. In my view, it is in demand, and it's in a new fresh bull market. We were known for calling this not a bottom when everyone else called it a bottom, and that year would be a halvening from the 6k levels down to 3. We had a target of 3.7. It tapped out at 3.2 after running our target, set up the first upside in a trend. We were a bit slow to be on that one on the way back up. This is now against the Korean won. You've got kind of so let's clear this all. You've got kind of lifting shoulder here, then bowling head, and you had a very small dip. I have to drop time frame for you to see that even. It was a very rushed right shoulder. There we go on the blue line. You can just about see it here. And since then we're bullish. That's a bullish candle after a very strong breakout. We may even run that. I prefer if it doubled back down and gave us a little squeezy. The volatility gives you that spring to the upside. It also gives you a tight risk for your stop and a mega expansive reward. That's what HVF trading is all about. Get in touch for a course and a program learning to identify those. So Bitcoin USD, let's take you to the big daddy in the chart that most people know, still holding up strong and looking good. It looks like strong for RH2. I think it needs a little bit of a rest back, as I was saying, needs a little bit of a rest back. There was that bottom that wasn't a bottom. Let's get it back to the daily. I think it needs that little bit of a rest. It would serve it well if it took a small rest, just to take a little bit of the sizzle out right now. Down, a little bit of basing out, and again but maybe in an accelerated. Again, I'm wanting squeezes everywhere. I wanted to go quiet, volatile, low volatility to high volatility expansion. But you might say, oh, that's against the dollar. Let's have a look at it against other currencies. So let's do this whole sweep. We're doing the whole sweep. We'll do whole sweep. If you're an FX trader, you want the yen. You want the rand versus the yen. Not a huge differential in interest rates. You want the Polish zloty against the yen. You want a yen long. If you're an anything trader, you can or crypto trader, you want to be long Bitcoin. You want to be long Bitcoin to fiat. Generally, all fiats. But if you can substitute it with a weak fiat, you're going to do just dandy. Especially a weak fiat that doesn't have higher interest rate. So the euro is a great one. So BTC euro is classic because it actually doesn't cost to substitute euro for dollar in your short. So you can go long BTC USD and short euro USD. You can hedge out your dollar and you can effectively be long a BTC euro. Many of the exchanges do BTC euro, so you can do it. And the euro is just weak, and you saw the Deutsche Bank, and you know what Barclays is looking like. It's a bag of the EU's got to unravel. I don't think it can survive what's coming. They'll try bundle it together. I hope Britain manages to escape. I doubt they will. And that's where I stand on all that. But this is really strong. Nice cupping. This is real bowling out. Nice little parabola. Short little breath of a pullback and another second. If it can top out there, everyone will go double top, double top. No, it's not a double top. It can be nice continuation. Nice steady climb. Nice continuation. If we get a little bit of a easing, topping and easing, and then a third impulse. And off we go to the races again. Very, very powerful. Going to be potentially in double digits faster than people realize. This is in euros, so the 10,000 euros, quite a key level. It's up top there, and that was quite a resistance. So, but certainly in dollars, I can see it coming fairly soon, and not too long after in euros. So we are long the cryptocurrencies. Which ones, you might ask? Well, this is going to be just generally Bitcoin. I do a whole crypto analysis of who you should be, and I don't look outside the top 10. And most of them are in the top 5 that we're looking at. Litecoin's been the star. Litecoin's been the star of late. Okay, so let's close the draw tool, close that, and finish running through this. So what about Bitcoin against the strongest? You say the yen is the strongest currency. Does it look bad against the strongest currency? No, it doesn't. There was that downside sell-off. There was the target. It subsequently invalidated that funnel. Now it's now in a bullish state. It looks like all the other charts. In other words, what you're seeing here is Bitcoin DNA. It's far more volatile than the FX. So every chart looks similar. It's Bitcoin you're looking at. You'd get minor variations. There's the pound. You get minor variations in terms of how high it's slung. The pound has been very weak. It's already quite a bit higher than its downward setup. Here's the Mexican peso. Very similar, you know. Here's the Turkish lira. That's been a hell of a currency. That's just been awful. Well, it still looks very similar. Still looks, let's get it into weekly mode, please. Still looks very similar. Slightly different little piece of action there when it was going all crazy. So let's have a look at Bitcoin USD divided by gold. Okay, so our strongest currency is actually gold. Gold is money. So our strongest currency is actually gold. So we have a look at Bitcoin and we divide it by gold, and we still see Bitcoin's dominant DNA, a recovering bull market. Let's change it to the daily, because we have less history. Look at that and tell me you would rather be in the gold. I love gold. I want physical. When grid is down, electricity is down, mobile networks are down, you've got to have some gold. I'm not having gold. Don't get me wrong. But in terms of out and out speculation, assuming I have a PC, an internet connection, and I'm able to trade, I am getting long Bitcoin. I am getting long Bitcoin. First prize to make the shekels in the crypto market. I'll do my relative assessment once I'm in there. I might pick up some Litecoin, I might pick up some ABC, I might pick up some EOS, I might pick up some Binance coin. Yes. Bulk of it, 50% holding minimum Bitcoin. Okay, you're not going to go wrong. Okay, so let's have a little look at what else have we got for you? Any charts? Have you ever done so many charts? There's a lot of charts, man. There's a lot of charts. You want to do this properly. Do you want to do this properly? Do you want to do it properly? I want to do it properly. I'm going to show you how you do something properly. It doesn't come easy. You've got to look at charts. Okay, you got to do your relative value of assessment. Against silver, same story. This is all the Bitcoin chart. Same freaking story. Beautiful little continuation. Down she goes to the bottom. Now nice rounded bottom. And there she goes. And silver's actually been weaker, and you're already quite a bit higher than these previous levels that were your last major downside, where you had a target performance on your short. We took that on the dollar side. That's it. It doesn't matter which precious metal you look at it. That is the game. Ladies and gentlemen, I have now given you all the cross pairs. If you're an FX trader, you want to be long the JPY, you want to choose a weak emerging. If you want liquidity, yes, you can trade the USD, but better to do the Euro JPY. If you are anything's trader, certainly be long the cryptos. Certainly be along the cryptos against anything. Bitcoin, get a Bitcoin position. If you are equities, be short the automotives and expect a crash to come. But it may pump first. Timing is going to be tricky. They're going to keep the game going for the billionaires and the insider buying. Although the insiders are selling, the lent money that's going against the balance sheet in the business is still going to be going buying. There will come the big short. It's going to be tough to call. Indices grind upwards. They always twist the knife one more time. That'll be a tricky one to short an overall index unless you have real structure and pattern on your side. Individual sectors like cars, down. But be selective. Watch it with Tesla. It can snap back rally. There's silent money supporting that for a bigger game. You saw the two retail stockbrokers. Don't like them, downside. Their clients are not making money, and they don't know how to make money when it's a shorter's market. This is a key point. Nobody knows how to make money in a shorter's market. They don't know how to short. The true trader is one who can sell and make money. The true trader is one that can sell and make money. You need real method and real capability to make money when most things are going down. I've shown you a few things that will be going up. The yen, the cryptos and precious metals, particularly gold. Platinum not yet ready. Platinum not yet ready, but one day ready. Accumulate on the lows, providing you can hold and see through a worsening first before a major re-rating. Okay, that's everything I've done for you guys. There isn't anything more. Short high yield debt if you feel like it. SHYG, HYG, knock JPY. You can trade that one if you think oil's going to be one of the ones that lose. Oil can go down. I never took you past the oil chart. It's enough. It's over an hour and 20. You've stuck with me. You are a freaking legend. You truly want to learn. You are one of the shining stars. You've been given the keys to the kingdom. Go forth and multiply, become wealthy, be awesome. And come to themarketsniper.com if you want to learn more about HVF method and be part of a great community. With that, I love and leave you. Enjoy your weekend. Bye for now, bye for now, bye for now. This is a reset sniper, a market sniper, and a crypto sniper production. Which channel do I put it on? Maybe all of them. Speak to you later. Enjoy yourself.